Okay, so stick with me here. You thought it got quite technical, but I do want to go over one other thing that Andrew Bailey mentioned.
But are you also to blame? Because today you're saying, well, we're going to be gradual and careful in our interest rate cuts. Are you once again too slow to boost the economy in the way that some say is needed?
There are two things that make up the underlying growth of the economy: the supply of labour and productivity.
And that is how the cut of the Bank of England's interest rates from 4.75% to 4.5% has been done to boost the UK economy. So there is a few things that happens, and that happens in 5 different ways. So one is lower borrowing costs. Money flows into the economy and it creates stimulus in the market. It also encourages house buying and construction. So cheaper mortgages means that there is more demand for purchasing property, and developers might build more property, and therefore, because there is more supply, this either means that property prices will lower, or because there is higher demand, property prices will be getting stimulus in the economy. This also means as the interest rate lowers, that means this reduces the savings and encourages spending. So lower rates mean that people earn less on their cash that is sitting there in the bank, and instead of saving, people are more incentivized to spend more. Does this actually work? So if confidence is low, i.e. if there's a recession, then people might not want to spend more, even though they're not earning a return on their investment if they keep their cash in a low interest savings account. If inflation is too high and there is too much spending, this creates the market to overheat, and there is too much stimulus in the economy market, and therefore things will skyrocket in terms of inflation, and things will just end up getting worse.